Hello, everyone. Thank you, everyone, for joining us today. We are about to start. If you want to leave in the chat where you're from and from where you're watching us, we are happy to have you all here. We're going to wait 1 more minute so everyone else can join us. Please feel free to use the chat to ask Paul all the questions that you may have during the webinar. And also you can use the Q&A box in case you have any questions, so Paul is able to answer them as soon as possible. So we have Paul Lamnatos with us today talking about maximize your ROI, a deep dive into the top 5 loan programs for real estate investors. And we are really happy to have him with us today. And we are Real Estate IQ. Your deal is our mission, and we are deal maker and dream maker. And we provide the best real estate solutions, committed to help one more person to win. So make your deals come true. This is the streamline your deal making process. So these are the solutions that we provide. So we offer off-market leads. We provide daily updated lists Monday to Friday of motivated sellers to contact. So get the freshest data mined straight from the card houses. We also offer EVA CMA, run real estate comps in seconds with our renewed CMA. You can check each property's data, select the ones to compare, and get reports instantly. We also offer custom leads mining. If you're looking for specific area leads, look no further. We now provide custom off-market data mining all over 50 states. And we also offer you virtual assistants. So one solution for administrative tasks, customer service, and technical support to grow your business. So let's walk together toward your success. If you're looking for more, please try our exclusive membership. So thank you, Carissa, for sharing. So we have an investor and agent here in South Austin, Driftwood, Texas. So thank you for sharing your contact information. We love to have all your information so we grow this community and we have networking. These are our social media accounts where you can follow us as well. We are in Instagram, Facebook, LinkedIn, and YouTube. And you can use the QR codes that appear below of each icon so you can join us in our community. And you can also use the QR code that appears on the right side of the screen so you can join us in our newsletter and you don't miss any of our weekly webinars and in-person events. You can also get a free 30-minute in-depth consultation of Real Estate IQ's services with one of our experts. Feel free of schedule it now by scanning the QR code that appears on the screen or by sending an email to bracenet@realestateIQ.com. This is a very short video of what we do at Real Estate IQ. Okay, so moving forward with Paul, thank you everyone for attending, and thank you, Paul, for being with us today.
I think that's the fastest I have ever transitioned that.
Yeah, I guess it
Look at
was.
this. I mean, that is great. Thank you for having me. I always love coming on Real Estate IQ. I often share how once a long, long time ago, I was at the Rich Club, which is an acronym for Realty Investment Club of Houston. It was a cold Saturday morning, about 7:30. I'm logging in all of our marketing materials, and I look over and I'm like, who's that guy? Long story short, Steve Liang and I became friends on that day. And that was, gosh, it's got to be 8 years ago. Time flies. So always love coming on. Thank you for having me as a guest. I do want to get us going. And if you have questions as we're going along, just pop them in the chat and we'll go from there. So for those that don't know who I am, I'm a first generation Greek American. I am a husband and father of 3 children, ages 5 and under. Active real estate investor. I've been doing this 21 years. I lend private money. I've closed a whole bunch of loans. I am a traditional mortgage broker, and I love coffee. I love good wine. I love bike rides and Texas Hill Country. Well, as the kids say, is my jam. Do they say that anymore? Or is that just what we used to say? All right, if you don't have something to write down with, you'll pull it out, use your phone, use the device. I will give some good nuggets here. So please feel free to take them down and use them as your own. By a show of hands, who believes this slide here to be true? Okay, awesome. Who doesn't? Okay, awesome. I like to say that knowing is half the battle. Of course, it's not me that said that. G.I. Joe is an old commercial. If you're in your 40s or older, you likely know this commercial. I don't know if the kids today know this cartoon, not commercial, cartoon, but it always ended the same way. Did not knowing is half the battle. And I always use the Valentine's Day as a reference to this. See, Valentine's Day is coming up here in about a week's time. And I know to buy my wife chocolates. I know to buy her flowers. I know to take her to dinner. I know to be sweet. But the reality is, what I need to know is to make a reservation. I can't believe I've forgotten. If I don't do these things, well, then it's pointless. So knowledge is not power. Knowledge plus action is power. So this is my invitation to you as I make a note to make Valentine's Day reservations. Is I promise I'm going to make some good nuggets here, give some good nuggets and some information that you haven't heard of before. So my invitation to you is to apply what you learned here today. So with that, this is what you should know as a real estate investor: how many properties you can buy now, how many you can buy in the next few months, how many properties you can buy over your career, and what you need to do to really turn that answer into unlimited, as many as you want. Are you married? Does your spouse want to buy investment properties? There's tricks here to where you could double up on the amount of properties by not putting them both in yours and your spouse's name. Instead, you put one in your name, one in your spouse's name. Therefore, you're able to double the amount of finance properties you can get with Fannie Mae financing. Excuse me. Do you have a sphere of influence you can tap into? Look, Blink Lending was founded on sphere of influence. It's mom, aunt, realtors that I know, friends that I know. It's who is your sphere of influence and how can you leverage that within your business? And then are you pre-approved with an investor-friendly lender? Getting pre-approved with your bank is great. When it comes to buying investment properties, especially once you're buying multiple, you really want to get with the lender that knows their stuff. So when it comes to financing options, you got 5 options here. You've got conventional, you've got non-QM, which stands for non-qualified mortgage. You've got commercial lending. You've got private and hard money lending. And every now and then I've got someone that goes, well, Paul, shouldn't family, friends, and acquaintances be in the private money bucket? I get the argument. I make a case that they should be a separate category. And this is just an underutilized category that I truly, truly feel you should tap into more. All right, so let's go into each of these, and it is always my clicker that wants to give me a challenge. What's going on now? The manual doesn't work, nor does the clicker. This is fun. Wow. We just skipped. Okay, so before we get into the loan programs, what I like to do is talk about credit score. And the reason I talk about credit score is because it doesn't matter what your options are if you don't have good credit. See, conventional financing is built on credit. Non-traditional financing is built on credit. Even hard money financing, when you get it from institutional places, is built on credit. Friends, family, acquaintances, private money there, you might be able to get away without it, but you need, the better your credit, the better the financing. So if you're putting yourself in a position to where you are maximizing your credit score, what you're going to do is you're going to get amazing financing over the life of the loan. So I always like to bring this slide up and talk about credit before going into loan programs, because every loan program is going to start with the credit score. So you want to look here and see where you fall with your credit score. And if you're not a 780 or above, if we're having a conversation right now, you go, Paul, what should my next steps be? I'm going to say two things. One, find a property, because nothing happens unless you have the deal. Two, I'm going to tell you to get your credit score higher. Because what happens is, if you're going to keep this property for a short-term period, you want good short-term financing. If you're going to keep this property for a long period of time, well, you want great long-term financing. So where you see your credit score here is you just want to get it up and increase it. All right, so conventional financing, this is your first option here. What's important to note about conventional financing is that it was created by Congress, it's federally backed funds, and they come with personal income qualifications. So if you're someone that's, when I say personal income qualifications, often I have someone in the back go, yeah, well, I don't have a W-2. That doesn't mean you don't qualify for this. It just means that the loan is based on your personal income. So what do your tax returns say? So you're going to verify your income with tax returns, pay stubs, W-2s. If you don't have W-2s or pay stubs, you will have tax returns. So just because you're self-employed doesn't mean you can't get conventional financing. One of our biggest strengths is knowing tax returns and knowing how to qualify income on the tax returns and working with self-employed clients. But why I keep hammering home with this is you're going to notice with the other loan types that we have that they're not based on personal income qualifications. So interest rates today, 6 to 8%, maximum 10 finance properties. This is why I say if you've got a spouse, you got a trick here. And then you can close in your personal, you can close in your personal name. You can transfer title afterwards. That's a separate conversation. And you can borrow up to 85% loan to value. I do not recommend this loan. I always recommend 20, and I'm going to try to talk you into 30% down. And the reason for that is your terms get better. Now, each deal is unique and different in its own right. So if 30% down doesn't make sense for you on the property, we're not going to do it. But you want to look at the options. Most importantly, we want to stay away from the 15% down option. All right, second option is non-QM lending. This is non-qualified lending here. So these are private and public institutional funds. So to where first is federally backed, created by Congress, these are private and public institutional funds that have alternative income qualifications. So for investors specifically, it is the rental income that is brought in. So how much rental income is received in comparison to the cost of the mortgage payment? And that's where you'll hear terms like debt service coverage ratio loans or DSCR loans. Is they investor-friendly loans that are based on the rental income that the property generates. Interest rates here are 7 to 11%-ish. You can get 40-year loans here, and you can get interest-only option loans here. And the reason you want to consider these is because, well, they just make your payments lower. And often with real estate investors, we might buy a property that doesn't cash flow as good because it appreciates really good. And whenever the property is appreciating well, we still want it to cash flow, or we want the impact to be as less as possible. So a great way to offset that and still ride the appreciation is with 40-year loans or interest-only loans to where there's no principal reduction. There's no maximum amount of finance properties here, to whereas conventional financing, the first slide, you could have up to 10. Here, you can have unlimited. So there's no rules because, again, it's not based on your personal income, but rather the income the property is bringing in. You can't close the name of an entity. You can borrow up to 80% loan to value. Now, when I say loan to value, what I mean is loan to value in comparison to the value of the property. So when your loan is, let's say, 80,000, the value of the property is 100,000, you're getting a loan at 80% the value of the property. You can't close the name of an entity. Out of here. Awesome. Thank you very much. Please. Great. And you can borrow up to 80%, but the biggest challenge here is being aware of the prepayment penalties. So you're going to have prepayment penalties with these loans unless you waive them. Now, often I've got someone that goes, well, Paul, why wouldn't I just waive it? It's a good question. The answer is because your interest rate is going to be higher. So the question you have to ask yourself here is, am I better to take a lower interest rate today, knowing that if I sell the house or if I refinance within the next however many years, typically they're 3 to 5 year prepayment penalties. You can get them from 1 to 5 years. Typically they're 3 to 5 years. The lower the prepayment penalty, the higher your interest rate. So am I better off taking a lower interest rate, knowing I can't refinance for 5 years, or am I better off taking a higher interest rate and then allowing myself to refinance? These are tough questions. And depending on the property, depending on the situation, each property is going to show itself to have its own best, course of action with there. So again, I just want to say this again. You want to be aware of the prepayment penalties, because so many times I have an investor that it's like, Paul, I'm being offered a 9.5% interest rate by this lender. And, I just need a lower interest rate. What do you have? And I'm like, well, what's your prepayment penalty with that other lender? And they go, 0. And I say, okay. I said, well, I could get you a 6.5 if you want. And they go, that's great. Let's do that. I said, wait. I said, hey, what do you think is going to happen to interest rates over the next 1, 2, 3 years? What do you think? Oh, they're going to lower. Okay. Like, if you had to bet on it, like, how certain are you, from a 1 to a 10, 1 being not certain, 10 being really certain, that interest rates are going to lower in the next 2 to 3 years? Go, oh, at 9, 10. I said, okay, great. Then why would you take my loan with a prepayment penalty versus taking a loan that doesn't have a prepayment penalty? Because see, as investors, we're blinded by the interest rate. Oh my gosh, 6.5. Let me go get that rate. 9.5. Let me stay away from it. But on the other side, we're optimistic that interest rates are going to lower. If you are in the camp that thinks interest rates are going to lower, then you do not want to get a prepayment penalty with your loan. Because why would you shoot yourself in the foot? You're going to choose an option that has a prepayment penalty. Interest rates are going to drop. So when they drop, now you can't refinance to bring all that home. Because if you do refinance, you've got to pay a prepayment penalty. So although these loans, they're great loans, we just really, really, really want to pause and talk about the prepayment penalties. All right, so what is debt service coverage ratio? It's net operating income divided by the debt service. Pretty easy. Let's take a look at how that works. So does my clicker work? Yes, it does. All right, so what's included in debt service? Principal, interest, taxes, property insurance, homeowners insurance, homeowners association. Let's fill out the blanks. Total payment for this property is $1,839. So net operating income is $2,350. Debt service is $1,839. Debt service coverage ratio is 1.28. So the debt service coverage ratio in this example is 1.28. Anything above 1% is good because you're cash flowing. The higher, the better, because the more you're cash flowing. So that's how your debt service coverage ratio works. Want to see it again? Different example? Great. Same. What's included in the debt service? Here are the numbers. We take the net operating income, which is $1,500. We divide it to 1378. $1.09. Commercial lending. So again, you take how much am I getting in rents divided by what the property is costing me, and that gives you your DSCR. Commercial lending. This is non-Wall Street bank money, although You can have agency loans and non-agency loans. An agency loan is when it's backed by the government. A non-agency loan is where the bank is lending its own funds. These loans are approved based on cash flow, income qualifications. How much money are you bringing in each month? How much money is the property bringing in? And what is the overall cash flow of not just the deal, but the sponsors themselves? Prime or LIBOR is prime plus or LIBOR plus is how interest rates are determined here. And the fixed periods are usually 5-year fixed periods. So meaning every 5 years, you have to refinance your loan or your interest rate adjusts. Amortized over 15 to 25 years. So the key takeaway here is you're not going to find these loans fixed for 30 years. They're going to be over a 15, 20, 25-year period, fixed for 5 years only. See, banks, imagine if banks 5 years ago, your small local community bank would have lent money at 3% over 30 years. Oh my gosh, they'd be bankrupt right now. So when loans are federally backed, you can get these low interest rates for periods of 30 years that are fixed. Even in institutional lending, you can have hedge funds come together and put 30-year fixed loans together. But when you get to this commercial type of lending, unless you get an agency loan, we're talking non-agency loans, which not to lose you in the explanation, but it's loans that are not backed by the government, banks lending their own deposit money. You're gonna have a hard time finding them fixed over a 5-year period and amortized over 25 years. Similar to the slide before, there are no maximum amount of finance properties. You can close the name of an entity, and you can also borrow up to 80%. So often I get people asking me, well, Paul, can I close my LLC? That's what I mean by entity. Private or hard money. These are institutional individual funds. So you can borrow these from a hedge fund that has private money. You can borrow them from a company that has private money. You can borrow from an individual that has private money. So these could be both institutional and private funds. The income qualifications are, it depends on the lender. Loans are based on the after repair value or the overall cost. So either the future value of the property or the cost up to a certain percentage. They're 9 to 12% plus is typically the interest rate. 6 to 12-month loan terms is what you usually find here. Again, there's no maximum amount of finance properties. You can close in your personal name or your entity. And typically you can get financed up to 75%, 70 across the board. Every now and then someone goes up to 75. So that's your private or hard money lending. And I always get asked, Paul, how do I calculate my cash to close when borrowing private or hard money? Well, I'm glad you asked. So get out a pen and paper, draw a line down the middle of the page, then draw a line across, give yourself about a 2-inch gap at the top. Left side, right money I need, right side, right money I get. And then we're going to have 4 rows under each column. Money I need is purchase money. You need rehab money. You need closing cost money. And then you need total money. Under money I get, we're going to put 70% of ARV. Line 2 is ARV equals. Line 3 is times 70%. Line 4 is total. So now we're just going to fill these in. Each time you get a deal, just simply fill it in. What's the purchase price? $245, rehab $75, closing costs are $12. You need $332,000 to buy this property. 70% of ARV is $315. We've got a difference here. The difference equals your cash to close. In this example, $17,000. You need $332. You can get $315. See the example again. Pen and paper, we fill it out the same way, team. So listen, every time you have a deal, now all we do is we just pull this out and fill it in. Purchase price, rehab, closing costs, total, ARV, total, difference, cash to closing, $20,000. How to calculate your private or hard money loan payment. This is another question I get asked. Paul, how can I calculate my payment? Look, there's a quick and easy way. You just take your loan amount times the interest rate divided by 12 months equals your payment. For example, 320 times 10.99% divided by 12, 29.31 a month. Very, very easy. Now, that's not totally accurate. This is fast and it's accurate. Take the loan amount, 320 times 10.99. We divide it by 365 because that's how many days are in the year. We're going to round that number to the second decimal, and then we're going to multiply it by the 31 days in the month, or 29 in this example of February, or 30 in April, however many months, and then you get your monthly payment, which is $29.87. Last bucket, team, is family, friends, and acquaintances. Look, individual private funds really don't have income qualifications based on the after repair value or the loan to cost. You make up the amount of months that you want with it. There's no maximum amount of finance properties. You can close in your personal name, but you make it a win-win. This company is built on family, friends, and acquaintances money. We have borrowed millions through selling our notes. Often I do a webinar like this, and somebody that's watching will say, well, Paul, can I buy notes with your firm? You can. We sell notes. So if you're interested in that, please reach out. I'd love to talk to you about that. But this is a great bucket that you can go to find funds. Look, you do a lot of work, but you fall short of the follow-up. So this isn't part of the presentation, although I made it part of the presentation. And just a complete aside, just take a look at this. What this tells you is it's all in the follow-up, And as real estate investors, my gosh, all we have to do is follow up, and just we're so far ahead. All right, top 10 lender fees. These are stuff, in real estate, you make money when you buy. I want to say that again. In real estate, you make money when you buy. And very often, people will get not the best financing with, well, a good deal. If you have a good deal and you get bad financing with it, that good deal is going to turn south really bad. Now, let me tell you what questions I know you know to ask your lenders, especially when it's private hard money. You know to ask, what's your interest rate? You know to ask, what are my points? You know to ask, how fast can you close? You know to ask, how much money do I need to bring to closing? But I bet you don't know these questions here. And this is where you can save lots and lots of money. So send me an email and I'll send them to you. I'm kidding. Kind of funny, right? How much are your appraisal and other lender fees? What is your appraisal cost? Outside of your points, tell me how much your appraisal costs. Tell me how much your underwriting costs. Tell me how much your processing costs. Tell me how much your attorney costs. What loan term is for the rate and points that you're quoting me? Look, private hard money lenders are notorious for giving 6-month loan terms when you really need 12, because all they're going to do is set you up for extensions because they know you're not going to refinance it. What you're going to do is you're just going to extend with the current lender. So if you have a rehab that's going to take you a longer time, well, just always ask for a 12-month loan. Say, can I get a 12-month loan? Can I get a 9-month loan? I just ask for that extra time. That way you avoid the extension costs. If you charge extension fees, what are they? Flip side of that's, what if I pay off my loan early? If I pay off my loan early, do I have a prepayment penalty? Do you charge monthly servicing fees? If you don't know what a servicing fee is, that's a fee that you pay your lender to process your payment. What the heck? Yeah. There are companies out there that charge you money to collect your payment as if your payment's not enough. Do you charge loan payoff fees? There are companies that are going to charge you money for them to generate a document that tells you how much you owe them. I'm not making this stuff up. Are there drawer inspection fees? If so, how much? Every time I ask you for money, how much are you going to charge me? How fast do you fund your draws? Are you going to make me wait weeks, days, hours? How long do I have to wait? Is there an additional wire fee? And why is that important to wait? I'll tell you why it's important to wait, because if you got to pay your contractors and you're having to wait on money, well, you either have to pay them with your money or you have to upset your contractor. And you don't upset your contractor, so you pay them out of your funds. Well, now when are you going to be reimbursed for that? You want to know the answers in advance. It's not so much about the answer. It's about not being surprised by the answer. Is there an additional wire fee? Look, there are times the draw or inspection fee in today's market is about $200 to $300. So you have to pay $200 to $300 every time you get money because you're asking for funds and reimbursement. So you're being charged draw and inspection fees. And then on top of that, to send you the money, they're going to charge you a wire fee. The wire fee is always like $30, $50. The wire fees, when you're doing them in volume, are like $4 to $8. So I don't know where these $50 fees come up from. And you might go, it's not that much. Well, what if you get five draws? Now 5 times 200 is 1,000. 5 times 50 is 250. You just paid $1,250 on a, let's call it a $250 flip. That's half a point you just paid in fees that eat into your profits. Again, you make money when you buy. So the other stuff that we talked about, well, that was really good education for you. It's like, oh, wow, I learned some things about loan programs that I didn't know. Here's where you're actually saving money. See, if you ask these questions, you're going to save money. So I either pull out your camera, take a picture of this, pull out your camera, take a phone. Either pull out your camera, take a picture. Also, you can send me an email and I'll send this to you in a PDF with some explanation to it as well. So when you're calling and shopping around for loan terms, just pull it out, read it, ask the question. It's also on our website. And then, do you charge interest on the undrawn rehab budget? Check in here. I want you to pretend that you have a credit card in your wallet or purse, which most of us do, and your balance, available balance that you have is $30,000. You don't use $30,000, yet you're charged interest on that $30,000. I bet you'd be livid. And the reason that your credit card company is going to tell you they're charging you interest is, well, Jane, Joe, we have to put that money aside for you. Because we have to put that money aside for you, we can't earn interest on it. Therefore, we have to charge you interest. And you're like, no, you'd be absolutely furious. Now, same context. I want you to look and pay attention here. The total money you get is $196,000. But how much is your rehab budget? It's $42,000. So that $42,000, you haven't received it day one. So really, your 196, you've only borrowed 154,000. What are you paying interest on? Are you paying interest on 196,000, or are you paying interest on 154,000? Because I don't know about you, I want to work with the lender that's going to charge me money based on how much money I've utilized, and not charge me money on the full loan amount and tell me some baloney story of, well, Jane, Joe, because we have to keep this money aside for you, we can't earn interest on it. Therefore, you have to charge me interest on it. No, you don't. I'll go borrow it somewhere else. All right. None of this matters if you don't find a deal. None of it matters. You can get your team. You can do your LLC. You can get your company name, your business card, your website, your email address. None of that stuff matters. Let's find a deal. Now, I love this slide that I picked out here. And it says, it's just open your eyes. Like, they're everywhere, guys. Everywhere, gals. First and foremost, Real Estate IQ. You can just find them on their website. I have clients that call me and they find deals on Real Estate IQ's site all the time. Like, hey, I was like, where'd you find it? Real Estate IQ. I'm like, so wait, you're not out knocking on doors. You're not doing mailers. You're not sitting and spending all this money with wholesalers. Although wholesalers, I love them, and there are good deals and there are not good deals, right? That's why we have to look at all of them. But you'll just go online and just find deals online. It's like, yeah. So I highly encourage you to take a look at Real Estate IQ. You can also find them anywhere else online. MLS, Zillow, Realtor, Facebook, social media. Look, they're out there. They're just out there. Where else? Investors, they sell properties too, especially out-of-town investors. Wholesalers, you can drive for dollars. Probate attorneys, divorce attorneys, bankruptcy attorneys, neighbors, colleagues, friends. Look, they are everywhere. You can find the deals. Interest rates with us, 9 times out of 10 are going to be lower than with who you're working with when it comes to traditional financing. The reason for that is our interest rates are wholesale interest rates. Their interest rates are retail interest rates. So I want to say that again, 9 times out of 10, when it comes to traditional financing, our interest rate is going to be lower because our interest rates are wholesale interest rates, to where your bank, your online lender, your credit union, those are retail rates. Right now, for a home to live in, we are quoting between high 5s to mid 6s. And the difference has to do with cost. So if you're out shopping for a house, we'd love to give you an option. If you wanted to refinance, get some cash out, buy a vacation house, we'd love to give you options. Here's our website, blinklending.com. We have a bunch of loans. It's kind of like walking into a candy store and seeing a bunch of candy everywhere. When you walk into our office, we've just got loans, refinance loans, personal loans, cash out loans, vacation loans, investor loans. And we also sell our notes too. So if you're someone that's looking for an alternate investment strategy, you've got some money sitting around in your IRA, your 401k, your personal funds, and you want to lend it out and you want to earn monthly distributions in a first lien position, not a fund. Your money's not crowdsourced. It's not in a pool. It is on individual notes in a first lien position. All right, lastly, you wouldn't go shopping without your wallet. Don't go house shopping without your pre-approval letter. You can get one instantly on our website, which is blinklending.com. You just go to blinklending.com. You answer, it takes you 60, 90 seconds to complete a form. I don't pull your credit. I don't ask for your documents. I simply say, hey, answer these questions. Based on the answers you provide, you get a pre-approval letter that says you're pre-approved. So there's my direct contact information. I wanted to, okay, I didn't go over too much. I wanted to keep this one nice and good and not drag it out any longer. If anyone has questions or if there's anything I can do, please reach out. There's my direct contact information, my cell phone, 281-221-7383, my email, paul@blinklending.com. That's PAUL@blinklending.com. And I do from now and time to time post on Instagram. So if you're looking for different educational videos, you can find them there. So I thank you guys so much for your time. If you have any questions, please fire away. If not, I'll stop the webinar and we'll all go have a tremendous Tuesday.
Thank you very much, Paul. We encourage everyone to ask if you have any questions to Paul. If not, please feel free to reach him through Instagram, through email, or through blinklending.com, or through phone number. We have people raising the hand. I don't know if anyone wants to use the microphone. Joshua is asking if you do any coaching.
No. Well, we have our team here, our loan officers. But Joshua, give me a shout, and I'd love to chat with you. But no, nothing on a formal sense like that. I'm flattered you asked, though.
Thank you, Joshua, for asking.
Yeah, please reach out.
Dominga is asking, where are you located?
I am in Houston, Texas. That is Heights Boulevard behind me right there. So our office is in Houston, and we service all over Texas. If you're outside of Texas and you have questions, please call me. Please send me an email, and I can get you the answer, and I can point you in the right direction. If I can't, I'll tell you what I would do if I was in your situation, which I still think is helpful.
Great. Thank you. Anyone else?
Hey, we're taking it easy on me today. I have had the worst headache all day. I think I'm going to go sit on that chair and take a nap. So if you reach out and I'm a little late getting back to you, no, it's because I'm probably working on a afternoon snore. Awesome. Well, listen, you guys have been great. Thank you so much. I really appreciate it. If you haven't checked out Real Estate IQ demo, please do so. They're an absolutely amazing company, and they really support the real estate investor, which is just so important.
Thank you, Paul, for your kind words, and thank you for being with us one more time. We expect you in future webinars, and we expect you all in future webinars as well. Thank you. Have a wonderful week, and hope your headache gets better. Bye-bye.
Yes, thank you.
Bye.